Hey everyone, and welcome to The Explainer. Today we're diving into a seriously dynamic trading session from August 7th, 2026. If you are watching the tickers today, you already know it was defined by these intense opposing forces. We're going to look at the day's theme as this massive market tug-of-war. On one side of the rope we had some incredibly heavy downward drags pulling everything lower. But on the exact opposite side, we saw this surprisingly strong upward shield trying to hold the line. It's a fascinating look at how different sectors react to global and domestic news. And, well, we've got all the data right here to make sense of the whole shebang.
Okay, let's just dive right into the reality of it up front. It was a red day. When that closing bell finally rang, the Sensex had dropped roughly 466 points. That's about a 0.59% slide, closing out around 78,488. It opened on a negative note and pretty much just hung out in that territory all day. Now, while numbers were bouncing around a bit during trading hours, that final closing snapshot paints a really clear picture of a market facing some serious headwinds. But as you know, a simple headline number never really tells the whole story, does it?
And that brings us to the most important question for any investor trying to navigate this kind of landscape. Why did the market stumble today? What exactly was applying that 466-point downward pressure? To really understand this overall negative trend, we need to isolate the specific sectors and the specific news items that acted like giant anchors on the domestic indices.
Section 1. What dragged markets down? The heavyweights fall. Now, taking a look at this, it brilliantly illustrates exactly where the pain was concentrated today. The broader Nifty 50 index closed down roughly 90 points, which is a 0.37% drop, settling around the 24,545 mark. So, a noticeable stumble, definitely a slight negative bias. But look at the banking sector. It faced a much heavier drag. The Bank Nifty saw a steeper 0.45% drop, bringing it down to the 65,596 level. There's just no denying it. Financial services and banking were absolutely the heaviest drag on the entire market today.
So, why exactly were the banks struggling so much? Well, it really comes down to a potent mix of domestic policy and global anxiety. First and foremost, we have the Reserve Bank of India's draft banking norms. These new draft regulations introduced a lot of concern, putting some really intense selling pressure directly on financial stocks. Investors were clearly reevaluating their positions in light of these potential new rules. But that domestic banking pressure didn't act alone. It was coupled with external factors, specifically renewed geopolitical tensions in the Middle East, and a general air of caution as investors globally just kind of held their breath, waiting for upcoming U.S. jobs data and some key corporate earnings. Moving on to Section 2, the global oil threat, macroeconomic pressures. This is the headline that literally had oil-sensitive stocks flashing red all day long. Brent crude spiked past $83 per barrel. The trigger for this sudden surge? A wave of conflicting statements regarding a potential U.S.-Iran peace deal. And look, without taking any political sides here, what we're actually seeing is just pure market mechanics at work. Markets absolutely thrive on predictability, right? So conflicting reports about peace agreements create this immense uncertainty regarding global oil stability. And whenever supply stability is questioned, prices are going to jump. So the crucial point here is understanding exactly how an $83 barrel of oil overseas directly hits the Indian stock market. It's all about the import cost concern. India imports a vast majority of its oil. When crude prices rise globally, the country's import bill inflates, and it inflates rapidly. This puts immediate direct pressure on oil-sensitive domestic stocks. We're talking aviation, paints, logistics, and it casts this huge shadow of inflation over the broader economy. To put it simply, it was a massive trigger for today's overall weakness.
All right, let's pivot to Section 3. IT sector to the rescue. Market shock absorbers.
Given the intense pressure from the RBI draft norms on the massive banking sector and that global macroeconomic threat of rising crude we just talked about, we really have to ask ourselves, what actually stopped a total market crash today? I mean, why was the Sensex only down 466 points and not significantly worse? Well, now, what's really interesting about this is that we saw the clear emergence of our market shock absorbers today. Information technology stepped up in a huge way. Leading the charge and actually standing out as the absolute biggest gainer of the day was TCS. They closed up a very impressive 2.39%. Right behind them in positive territory were IT giants Tech Mahindra and HCL Tech. They essentially acted as a massive counterweight to all those financial sector losses.
We can officially call this group the support shield of August 7th.
Joining TCS, Tech Mahindra, and HCL Tech in this positive territory was Infosys, which really further cemented the IT sector's role in limiting the downside today. And actually stepping just slightly outside of IT, we also saw the energy company NTPC secure a solid spot on the gainers list. Together, this shield is really what kept the domestic indices afloat and prevented a much steeper, far more painful decline.
Let's bring it all together in Section 4, a market divided. Broad market breadth. To get our final verdict on how investors are truly feeling right now, we have to look beneath those big headline index numbers. And the BSC market breadth for today is incredibly revealing. Out of 3,888 total stocks traded, we had 1,875 advancing and 1,767 declining, with 246 remaining totally unchanged. Think about that for a second. Despite the Sensex dropping over 450 points, the actual number of individual stocks going up was slightly higher than the number of stocks going down. This tells us, for sure, that today wasn't a day of widespread blind panic. It was a day of selective, cautious rotation. Basically, investors were dumping banks, but they were actively buying up IT. And the extremes of the market today perfectly reflect this divided, cautious mood. We saw 115 stocks hit their 52-week highs today, but at the exact same time, we had 110 stocks locked in lower circuits, meaning they fell so incredibly fast that trading actually had to be halted. Meanwhile, 98 stocks were locked in upper circuits. It's literally the very definition of a mixed market. Retail investors are carefully trying to navigate these competing forces, and it's resulting in these wild polarized extremes. Which leaves us with the ultimate question as we wrap up today's explainer. We saw the tug-of-war play out in real time today. Domestic banking fears and global oil spikes pulling the market down, while the mighty IT sector pulled it right back up. But with geopolitical uncertainty continuing to swirl and crude oil still hovering high, how long can the IT shield hold against these rising global pressures? It's definitely the key dynamic to watch as we head into tomorrow's trading session. Thank you so much for joining me to unpack all this data, and as always, keep your eyes on the markets.